There are only two trading methods that you must know before learning or doing anything else. They both combine concepts of price action and market structure. We start from the simplest way or the simplest method, and we'll get into the advanced later. In the simplest way, while having an uptrend, the market will often print this type of price action where we get some significant momentum to the upside. That is later followed with a price action that's slowly pushed down. This downwards action is a pullback to the downside of the uptrend. And this pullback, as long as the market is in an uptrend, it likely ends with a continuation of the initial price action. So the initial one was a push to the upside, so that means that after the pullback we get another push. Basically, after the pullback ends, a similar move to the initial one is expected. And when this happens during an uptrend, we constantly break the highs. This break is called the break of structure. After the break of structure, the market will more often than not form some kind of pullback once again. Similar to the last one, of course, a pullback during an uptrend is a small bearish movement to the downside. But as before, as long as the market holds an uptrend, that means that we will probably see another continuation to the upside once the pullback ends. And if we think logically, it's smarter to buy at the lowest price we can. Now, of course, we won't hit exactly the lowest, but we only need an approximation. And the lowest we can usually buy is found on a demand zone, which is the last bearish candle right before the market started to push to the upside. And this is not difficult to identify. We just look at the largest bullish candle on the lows, which is this one, and the last bearish candle on the left is this one. And this is the demand. And that's the level where we look for buy positions, entry on the top of the demand, stop loss below the structural lows. So in other words, below the lows of the recent price action that formed the demand. The take profit, we want it to be above the last high that we're able to see. This gives an almost 1.4 potential risk to reward ratio. It's decent for beginners trading this simple approach, but I'd go for a minimum of 1 to 2 ratio. We would lose this in two scenarios. The market can fill the demand and just break down the demand. In that case, we take the loss without crying too much about losing this setup. Because if you're smart and have been a long-time viewer of my channel, you know that a break of the demand means that we also broke the last low, and the break of the past low on an uptrend is a bearish market structure shift. So this means that the trend has likely reversed into a downtrend. And we apply the same theory just like we did on the demand, but now for supply zones. And instead of looking for buys, we look for sells, but we will get into a setup like this maybe later. So this was the first scenario where we might take a loss. The second scenario happens a lot more rare, and that is the market filling the demand and bouncing up from it. This time respecting the demand, but then the push to the upside is not strong enough to reach the take profit. And then maybe later it eventually reverses to the downside, entering into the first scenario. This rarely happens, and it's not that hard to avoid. We mostly need to target just decently high enough risk-reward ratio to get as much as we can out of the trade, but not too high. Basically not placing the take profit so far away. From what I usually see, what works well with this simple approach is upwards to 1 to 3 ratio. I wouldn't go above 1 to 3, but also I wouldn't go below 1 to 2. So it goes higher for a few more candles, then it drops down, hitting into the demand, opening the position, and following with a beautiful bounce to the upside, taking profit out of the position on a win. Now, as I said before, this type of move usually repeats constantly because it's what it holds an uptrend. Notice how we broke above the last high. So just like before, we got a bullish break of structure, so there is good probability that it will eventually pull back down and bounce to the upside again, giving another opportunity for potential buying setups. Now on the Nasdaq, on the 4-hour chart, we also have an uptrend, of course by repeated higher highs coupled with higher lows. And on the last move, we have an impulse to the upside that broke the last high. This marking the bullish break of structure. After a bullish break of structure, while having the market going to the upside, the market, as I said before, will likely pull back down so it can form another higher low. And it's from there where we look for possible demand zones for potential buying setups. The placement of the stop loss and take profit is as it follows on uptrends. The stop loss below the last structural low and the take profit above the last structural high. The market begins to pull back down, but it went lower, breaking down the demand and closing on a losing setup. So if we check how the entire price action has moved since the beginning, we see that it has been increasingly going higher, just like I said before, forming the higher highs with the higher lows. If that price action would have repeated, the market should have formed another higher low, which would fill this buy position, followed with a higher high that breaks the past one, this hitting on the take profit. But instead, we got a lower low, with the market breaking down below the demand, and coupled with the break of the last low, this marks the bearish market structure shift. Now we want a clear view of what just happened, from this high specifically, because we did see formation of a downtrend. Now of course this doesn't mean that the entire market is a downtrend, but only the internal price action right here. However, the entire market, also named as the external price action, or the external trend, was still in an uptrend. This happened until it broke the last low. When the market structure shift happens, that's when the external trend reverses into a downtrend, basically moving together with the internal trend. On downtrends, it's no longer demand zones that respect, but it's the supply zones that do. For example, on the top of high right here, we see a supply that has worked. However, this could have not been traded, because when the market was at this level, we still had no idea that we were going to drop and break the low, reversing into a downtrend, but we just use these as an extra confirmation. Basically, if we see that many supply zones have formed, the price filled them and rejected back down, the more it increases the chances of a next one doing a similar pattern, especially now that we broke below the low and the downtrend is basically confirmed. So we have the last available supply that is not filled yet. So far, each one is filled and respected. So we place a sell short position on the supply, which, by the way, as you should know, the supply is the last bullish candle before a downside impulse. Now the stop loss is placed above the supply, since on uptrends, we do not expect highs or supply zones to break to the upside. For the take profit, structurally should be placed below the last low that we can see, but you should not always follow the theory, because in this example, if we place it below the lows, we get a 8.5 risk reward, which is hard to sustain. So the quality of the setups decreases when the risk reward becomes too low, but also when it becomes too high. A more realistic and sustainable one using this simple approach is about 1 to 3 or so. The market pulled back to the upside, and now it's consolidating below the demand. The demand got filled with a wick, which it also means that the order got filled. It almost hit the stop loss, but because of the smart or logical placement of the stop loss, we avoided getting stopped out randomly. Then it failed to continue the upwards momentum, finally aggressively pushing to the downside, eventually taking profit, and actually this dropped a lot lower, even breaking below the swing low. So this time, the theory respected, and we could have gotten a lot more out of this sell position. However, as I said before, this doesn't always happen. In fact, it won't happen most of the times. So be careful and target a sustainable risk reward. In this market, we initially had an upwards momentum that faded down with an aggressive downside movement, just 3 candles erasing all of the previous bullish candles, and now the market is trying to pull back to the upside. However, a pullback on a downtrend is there to fill a supply or resistance, from where the market can reject down into breaking the lows constantly. So what we need to do for now is to just identify the supply or the resistance. And here it's quite easy to do so. We look at the maximum high, which is also the last swing high. And specifically, the supply is the last bullish candle before the market started to gain bearish momentum. This is our supply. Supply that got filled a couple hours later, pretty quick actually. It filled right from this pullback. Now on the previous setups, we've done the simplest approach. This time we're getting into the advanced approach. In the advanced approach, we don't position the setup from the supply that we found on the initial higher time frame. But we still need to find this supply. And instead of trading right away from it, we just wait for the market to fill this supply. And then after hitting the supply, we switch into a lower time frame. And it doesn't matter which one, it can be any time frame. What's important is that it should be lower than the initial one, where we started to analyze the market. For example, this is the same market, same price, but on the 5 minutes chart. The movement is just shown in a different structure, but it has the same price it did on the 1 hour chart. Each time we move in time frames, we analyze what the market has done recently. Since we filled the high time frame supply, we're starting to see a formation of an uptrend in this 5 minutes chart. The purpose of the advanced approach is to catch the moment of the reversal from a low time frame, because structurally, the downtrend begins when the past low breaks down into a lower low. So, let's rewind the analysis real quick. So we've already spoken about the uptrend formation that we had, but then look closely at this price action right here, where we no longer have higher highs, but we have lower highs, and we no longer have higher lows, but this time we have lower lows. These two combined are what forms a downtrend structure, and because before this we had an uptrend, but then it broke the past low, this break is a trend shift from an uptrend into a downtrend. But pay attention, because this is a newly formed downtrend. But on the 5 minutes chart, because the 1 hour can still say another story. For example, what if the market goes down for a few more candles, but then it reverses back up, breaking the last high, and possibly even the supply, well then the 1-hour chart invalidates the downtrend, and the 5 minutes chart enters into an uptrend. But until that happens, the 5 minutes chart is in a downtrend, and we know that from the swing formations, now in downtrends we identify supply zones, exactly like we've done on the 1-hour chart, but we do so on this 5 minutes one. We look at the highest point, and to identify the exact level we look at the last bullish candle before the market started gaining bearish pressure, which should be this candle. This is the supply from the 5 minutes chart. Now we plan the setup exactly like we've done before on the simple approach, sell short on the supply since the market will likely form a lower high during a downtrend, with the stop loss above the supply because higher highs are not expected on downtrends. And for the take profit, when we use this advanced approach, we always zoom out and we target one of the previous lows, for example, this one, or the low from below, or even lower, depending on your risk tolerance and what ratio you target. The lower we target, the more the risk to reward increases. And this is about the most I would go for. There might be even a lower one. And yes, there is the final one right here. But this can be too dangerous since it increases the ratio a bit too much into a 1-to-7. So as I said, it's fine to target the one that's above, that still has a very good risk reward, which simply means that it's not too low, but also not too high. Now we have patience for the market to do its thing. So this setup was closed pretty quick. This bearish candle filling the order, then quickly pushing down and closing on this large bearish candle. Then the next candle also closes bearish and hits into the take profit. So from open to close, it only took 10 minutes for this setup. And now we're having a similar price action. So a pullback to the upside that fills a supply from the left, the supply being the last bullish candle found on the highs right here. And it's exactly there where this wick moved into and rejected back down, breaking the past lows. So a similar type of setup could have been opened. Still the same logic as we had on the previous one. Now let's try another one with the advanced approach. As always, we start with a simple analysis of the swing points on a higher time frame. This time we're using the 4-hour chart as the initial time frame, and from the beginning of the price action, we were forming a structure of an uptrend. Now from the maximum high to the last movement, we have a push to the downside, and this downwards push breaks below the past low of the uptrend. So this is a trend shift from an uptrend into a downtrend, since we went from having higher lows into now having the first lower low. Now these swing points usually go together, so we won't often see a lower low that is then followed with a higher high. But usually when a lower low prints, it should be followed by a lower high, so it can hold bearish continuation, basically just following the trend that it just started. And when that repeats, that's what a downtrend is. Pullbacks to the upside that many times fill some kind of supply or resistance that can give us a great opportunity to sell the market down. So we need to identify this supply in order to plan the setup, and the supply is found near the swing highs on the last bullish candle before the bearish pressure started kicking in, which should be around this level. It's from this candle that the next one started to push down and signal bearish momentum. The market then fills the main supply, and now it's when we get into the advanced approach, when we see the price into the supply from the high time frame, we zoom into a low time frame. We are now on the 15 minutes, and we look at how the price behaved right before it entered into the supply. And it looks to be following a clear and simple uptrend structure into the supply. But then, when it entered the supply, we see how the market is starting to reject to the downside, pushing down and trying to break the past low. Now this is a break of the past low, but with a wick. A break with a wick can still be a market structure shift. But because it decreases the quality, we want to look for extra confirmation. For example, if this would be a valid trend shift, we should see the market forming this type of price action. A pullback to the upside that gets faded down from a resistance or supply, pushing down and breaking the lows. So we identify a supply if there is one here, we look on the swing highs, and this can be considered as a supply, an internal one on the 15 minutes chart, which is inside the higher time frame supply from the 4-hour chart. We're pulling back into the supply, filling it, and it rejected down. So we validated that extra confirmation since we now see supply zones respecting. Now we look for the next supply that we can use for the setup planning. So we look at the next swing high. Around here, this is the other supply, and now we can try to enter with a sell short position, the stop loss above the highs. And for the take profit, we do a similar process as we did on the previous market, looking to exit below the last lows. Right here we have the first target, but the risk reward is not so great, so we look for the ones from below as well. This is a 1-to-2. It's getting acceptable here, but still not enough. We can target lower levels as well. Here it's a 1-to-4. This is fine, but there is the other low from below, where it doesn't increase the ratio by a lot from here. 4.5 is the most I would target in this case, so we stop here. Now patience, since the position already got opened by this candle. It drops instantly, really quick actually, then we get a bounce. And now it's consolidating. And the drop finally came back, closing the position on the take profit. For this, we use concepts of price action, market structure, internal and external trend identification. They're the main concepts more detailed in our program that you can find on the link in the description. Hope you found this video useful, and see you on the next one.